Hello, everyone. Japan's bond market has been the quietest place in global finance. It was predictable and it was stable. Investors around the world treated Japanese government bonds not necessarily as a source of returns, but effectively as a backbone of the global financial system, a place where nothing dramatic ever happened. But that era is now over. It is gone. This week, something unprecedented happened, and I want to share the details with you. We will also discuss how it affects the United States economy. Yields on Japanese 40-year government bonds surged past 4% for the first time since those bonds were introduced back in 2007. They didn't just creep higher, they actually jumped sharply and hit around 4.2% in a single session. For a country that built its entire economic model around ultra-low interest rates, this is a shockwave. It is a shockwave not just for Japan, but for the rest of the world, including the United States, because Japan is the biggest holder of U.S. debt. So everything is very, very interconnected, and this is not just a Japanese story. Of course, this move is already pushing a borrowing cost in the United States. It is shaking equities, it is lifting gold, and also reviving fears of a massive yen carry trade unwind. So what is happening, and why is the world suddenly so nervous about Japanese bonds? The trigger is politics. On Monday, Prime Minister Sanae Takaichi announced a snap parliamentary elections scheduled for February the 8th. She made it very clear that she wants a mandate for what she called, quote, major policy change. Investors immediately understood. They picked up what this actually really means. It means more spending, more stimulus, and looser fiscal policy. And this didn't really come out of nowhere. This wasn't really a surprise. As I mentioned in my previous videos here on my channel that I uploaded probably about a month ago, back in November, Takaichi unveiled a massive $135 billion fiscal spending plan. Then came another signal that markets around the world didn't really like, and that rattled them. It was her proposal to suspend Japan's 8% sales tax on food for 2 whole years. Now, truth be told, for households, that sounded like relief. But for bond investors and for global markets, it sounded like trouble, and a lot of trouble. Japan already has one of the highest debt burdens in the entire world. Depending on the measure, government debt sits somewhere between 200 and 250% of Japan's GDP. It used to be manageable because borrowing costs were close to zero. But when yields start rising, as they are now, the math changes, and it changes very fast. As a result of these reasons that I just walked you through very briefly, bond markets reacted immediately, very, very quickly. Traders began selling Japan's ultra-long-term debt, which in turn pushed prices down and yields up. The 40-year bond was hit hardest, but 30-year and 20-year yields surged as well. So in just weeks, 40-year yields, it actually jumped from around 3.6% at the start of the year, just 20 plus days ago, to above 4%. This is a massive move by bond market standards. So to put this in context, ultra-long-term bonds are less anchored by central bank policies and are far more sensitive to things such as supply, demand, and fiscal credibility. In contrast, short-term debt moves with interest rate expectations. Long-term debt moves with trust, which is being questioned, to put it mildly. One trader described the sell-off as a 2-standard deviation event based on the reports that I read, and in plain English, this was effectively panic level repositioning, panic level selling. Some of you may ask who is going to buy all this debt and at what price? And that is actually a very, very good question to ask at this point. Traditionally, Japan could rely on a deep pool of domestic buyers, of domestic investors such as pension funds, life insurance companies, and conservative institutions that are always hungry for long-duration assets. But that demand is actually fading. Demographics are shifting rapidly within Japan. Balance sheets are stretched in Japan and around the world. So the problem is there may not be a strategic buyer in the lawn. That vacuum actually matters this time around. At Tuesday's auction of 20-year Japanese bonds, demand was noticeably weak. The bid-o cover ratio came in below the recent average, and that reinforced the idea that investors are stepping back rather than stepping in. They're not really feeling adventurous. Rising Japanese yields matter because Japan sits at the center of global capital flows. For years, investors borrowed cheaply in yen, and then they turned around and invested that money in higher-yielding assets abroad, such as U.S. Treasuries, equities, corporate credit, and so on and so forth. The so-called carry trade became a pillar of global liquidity. But when yields at home rise, the incentives actually flip. Just think about it. Why take currency risk and leverage abroad when you can earn nearly 4% on long-term government debt at home in Japan? It doesn't make any sense to do that anymore. So if Japanese investors start repatriating capital, if they bring that money back home to Japan, global markets will feel that immediately, instantly. So we are already seeing early signs of that happening. On the same day that Japanese 40-year yields crossed 4%, as I just mentioned, U.S. 30-year Treasury yields actually climbed to around 4.9%, which was their highest level in month. Long-term borrowing costs are rising globally, not because growth is booming, of course, but because one of the world's biggest capital exporters is rethinking its allocations. If yields continue to rise, Japan's debt servicing costs will eventually increase. And as a result of that increase, it would effectively put pressure on future budgets. If the Bank of Japan steps in aggressively to cap yields to prevent them from rising further, the Bank of Japan will probably run a risk of weakening the yen even more. But if it chooses to do nothing, volatility could actually escalate. So you see how this is a very difficult position to be in, and it does appear that there is no good solution to this situation. Either way, someone will lose. And globally, the implications are just as serious. Higher long-term yields act like gravity on risk assets. They compete with stocks. They tighten financial conditions. And they also threaten to unwind years of leverage that is built on the assumption that Japanese rates would stay near zero forever. That assumption is now under threat. And this is why investors around the world are suddenly fixated on Japan. This is not because of growth numbers or inflation prints, but because of politics and confidence or lack thereof in Takaichi's fiscal policies. It's become clear that Japan can still spend. It sure can. But it can no longer pretend that borrowing is free. What happens between now and the February election could actually shape not just Japan's fiscal future, but the direction of global yields in the month ahead. And for a world that is already on edge, that makes Japan's bond market drama something no investor can afford to ignore. Let me know what your thoughts are on this topic. I would love to hear from you. As always, thank you very much for joining me for this video. I hope that you learned something new, and I hope that you enjoyed this video.